Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Jordan Roy-Byrne, founder and editor of The Daily Gold. Now, Jordan, all eyes were on the inflation data this morning that recapped June's inflation numbers and came in higher than people expected. We have, I believe, 9.1% inflation read. It really continues to be driven by, well, look, there's a lot of different factors that continue to push inflation higher. But we are getting a lot of people saying that this most likely will be the peak in inflation because of the sell-off that we did see now even in the commodities in the second half of June. Really is just all guesswork, but the fact of the matter is this is, I think, even more so cementing at least a 75 basis point hike from the Fed again. We even saw the Bank of Canada, I think, surprise everybody today with a 100 basis point hike, really making the same comments that the Fed is dealing with, mostly inflation. Jordan, what's your takeaway from that inflation data, and does it change any of your market outlooks, especially for the metals?
Hey, Corey. Well, it doesn't really change anything for me. It's backward-looking data. Well, that's what most economic reports are. Inflation is one of the biggest. It might be the biggest lagging indicator when it comes to, along with the unemployment rate, when it comes to economic data. As you noted, I mean, commodity prices have been selling off aggressively. If we look at oil, it's bouncing a little bit today from $95, but oil doesn't look too good technically. Maybe it could rally for a little while, but if that falls below 95, it's hard to say that it's not really broken. I mean, copper has obviously come down significantly. Even wheat, which went parabolic, that's come all the way back. So if you look at commodities, they're telling you one thing. If you look at the bond market, the yield curve is inverted. I mean, I did see this morning the 2 years rallying. It's above 3%. And that's sort of a Fed funds terminal rate, you could say. So that with that rate where it is, you would think that the Fed, they could get in one more hike after July. But then you look at the 10-year yield, and that's below, I think it's around 2.9%. So the curve is inverted. The 10-year yield is clearly telling you a different thing regarding all the inflation. And so to me, it's just a question of the statistics and how quickly they can come down. And that's really that's really the interesting debate to me is, what are we going to see next year? Are we going to come down to 2 or 3%, or is the next low going to be 4 or 5% for the level of inflation? I think that's what the key is. And, the Fed will obviously think about that. But at the same time, we're likely already in a recession. If you look at the bond market and break evens, which are an indicator of inflation expectations, break evens across the board have been coming down rapidly in the last couple months. And so break evens are saying, over the next, depending on which one you're looking at, 2, 3, 4, 5 years, inflation is going to be back down to 2 or 3%. And break evens have come down so fast. And I read something that the only other 2 times they've come down this fast were during the COVID crash in 2008. So the speed of the decline that we've seen in commodities and in break evens in the bond market, and the gold stocks are looking similar. I mean, this is starting to look like 2008 in the COVID crash. So I think the market is really sending a different message. And that's really, I think, the key, especially for precious metals. I mean, commodities, they're more tied to the economy, which is, I don't see a sustained recovery there probably for another 12 months. So I wouldn't want to be in, energy or copper or any of that. I still think there's a lot of downside there. But with respect to precious metals, they're going to lead. And so to me, that's really the interesting question over the next couple months is how quickly the focus of the media and everyone will turn from, well, inflation is really high. The Fed's got to hike rates. We got to get this down to the holy crap. We're in a recession. It's going to get worse. We have huge problems. We need some stimulus. We need some spending. So I think it's going to be important to watch that psychology, because the Fed is hiking rates for, I don't want to say psychological reasons, but they kind of are, because has been the biggest worry of most of the population. The Fed is a political animal. They have to hike rates and look like they're being tough on inflation. When if you look at the data, they shouldn't be hiking anymore, because everything is going to turn by itself. Inflation is going to come down. So it's a psychology thing. So I think when the psychology changes to being to everyone being more concerned about recession, that's going to be when the Fed pivots.
Yeah, Jordan, it's really an interesting scenario to be in, because many would argue that the Fed was responsible for a lot of this inflation with the insane money printing and liquidity they injected in the marketplace. Then they didn't want to act on inflation. Now they're acting on it a day late and a dollar short, as the narrative is quickly shifting from inflationary pressures to worries about recession. And we've seen that over the last month or two, more and more financial media worried about recession, which won't be good for commodities. But you've postulated a few times on our show that you thought gold would eventually diverge and it would be the first mover long before the rest of the commodity sector bounces. And just recently, you put out a piece to your subscribers saying this isn't going to be like 2013 and we aren't going to see a swan dive down in gold. I'd love you to unpack that, because there are a lot of worried precious metals investors. Why will this not be like 2013 in your opinion?
Yeah, well, I will say the charts do look concerning, and they look really, really similar, especially if you're looking at a big picture long-term chart. Gold does look similar to the tops in 2012 and late 1980, kind of you could call it a double top. So the price action definitely is concerning. But if we look at what happened in really in both those cases, gold had this massive sell-off coming off a bull market, and the stock market in 82 made a huge breakout. The Dow broke out above a 16-year base. 2013, the S&P broke out above a 13-year base. So those huge declines in gold they coincided with the stock market in the very early stages of and breaking out of multi-decade resistance levels. So that's really important. And if we look, and you could say, okay, well, what if we look at what happened to gold also the 10 years before that big decline in those breakouts in stocks? Well, from 70 to 80, gold was up 25x. Gold had a huge bull market going up 6 or 7x in the 2000s. And there was still a lot of money in gold. And obviously, if we look at gold today, it's at the same level as it was 11 years ago. So no bull market, no secular bull market there that is ending. And I don't have the statistics handy, but if we look at the amount of like ETF assets that's in gold, if I try and remember this chart, I mean, in 2012, 2013, I want to say it was still like 7, 8, or 9%. If we look at right now, it's probably around 1% or 1.5%. So because gold hasn't been in a secular bear market, it's not over-owned. I mean, it was significantly more over-owned at those 2 points. Also, gold right before that, or when it started to decline at the end of 2012, gold was below the 200-day with respect to gold against the S&P 500. So in real terms, gold was performing really poorly. Gold was coming off aggressively, but the stock market wasn't selling off. If you look at the macro now, what's happening? The stock market is in a bear market. It's, sold off aggressively. If you look at the economy, if we're not already in a recession, we're probably going into one. So there's, a good chance we're going to see the stock market eventually down 40% or more as this bear market and recession runs its course. 2013, in 82, we did have a double dip, but, 2013, there was no recession. Again, the stock market was very close to breaking out of this 13-year base. It's really the opposite this time, where it looks like the stock market the risk is it's going to start a secular bear market. And so when that happens, that's really good for gold, because it means gold is starting a secular bull market. So yes, if we look at the price action, the look of it is concerning. I mean, it is possible gold could take out 1675, over the next month or so, maybe into a bottom, in my opinion. So that's a possibility. But if we're standing back and looking at the bigger picture, that's really where the similarities end. Because if we look at where the two markets are positioned, the macro, the situation. Oh, another thing is gold has been, this time gold has been outperforming in real terms. If you go back and look at, 81, 82, 2012, 2013, the gold to the S&P ratio, it was crashing before gold had those big declines. I mean, this time around, yes, gold is looking like it's going to have a big decline, but in real terms, it's outperforming the stock market. That ratio is above a 200-day moving average, which is sloping higher. So if we look at all those things, it tells you that there's a lot of differences this time around.
All right, Jordan, we'll wrap it up here because right now, look, I think it's just still a tough market. Expectations that the Fed's going to keep on hiking. We'll wait to see if the gold stocks, really, if anything, starts to sniff out a Fed pivot earlier than the Fed does actually pivot. And hopefully a bit more buying comes into all these markets, quite frankly, because everybody's been under pressure, and that has contributed to more so just a race for cash. Even though the dollar's down today, the dollar is still at a very elevated level. Jordan, thank you for your time as always. We'll chat next week, and who knows what we'll be chatting about, but at least it won't be on the back of inflation data. Have a great rest of your week there, Jordan.